Welcome to the Headed Home podcast, everyone. We are going to dive into the world of reverse mortgages today with the one and only George.Tsoupakis, a certified reverse mortgage professional and an expert in the field. Thanks for being here today, George.
Thank you, Andrew. It's a pleasure.
Now, George, we've known each other for a few years now. And every time we catch up at the office, we end up talking about reverse mortgages. And I walk away from every one of those conversations having learned something new. So wanted to bring you here today because I want our audience to also learn about reverse mortgages. I think that it is a very important topic, not only in our industry, but also in our communities and in our families. So let's start with this, just kind of understanding the basics of a reverse mortgage. So can you give us just a brief overview of, what a reverse mortgage is and maybe how that's different from a traditional mortgage?
Absolutely. Thank you for the introduction, by the way, too.
Of course.
Just to give you just a brief history real quick. Back in the 60s, the federal government commissioned several long-term studies to find out what happens to the people when they retire. They followed people in their 40s and 50s when they retired in their 60s and 70s. And they found out over a 20-year period that the single largest asset they owned at that point was their home.
Okay.
Unfortunately, at that time, the only liquidity event you had for the house was to be sold. There was no other way to put liquidity into somebody's equity.
Right.
HELOC did not exist. So the federal government thought that what if we devise a financial instrument that we can insure, so basically FHA and HUD insures the reverse mortgage, give the homeowner the ability to put liquidity to that equity without having to sell the home.
Mm-hmm.
And at the same time, without having to make the traditional monthly mortgage payment.
Right.
So what we do is we defer the payment of the loan until the end of life, until the house is sold, or the last homeowner moves away for longer than 12 months, like a long-term care facility or something of that nature. So 20 years later, back in the 80s, that became a reality. It was passed as a law and signed by President Reagan back in 1988, simply because he was a senior himself. He had an affinity for all senior homeowners, and he believed truly that that was an actual beneficial financial instrument backed by the federal government that would enable every retired homeowner to be able to do what? Enjoy the golden years of their lives. So that's the brief description about a reverse mortgage.
Okay. When I think of reverse mortgages, and I've talked to you about this before too, I've been in lending for 15 years. I feel like I should know more about them. And when I got in the industry in 2010, I think there was just a negative connotation around them. Like I would hear people talk about, I don't want to do a reverse mortgage because this is my family home and I don't want to sell it to the bank. I want to hand it off to my family, but I like the benefits of the reverse mortgage. So maybe we can get to that and maybe talk about how the program has changed. But for now, like eligibility requirements, like how does someone even go about qualifying? Or maybe you could throw out just a few eligibility requirements.
Absolutely. Very easy process. We have two different reverse mortgages right now. One of them is the HECM.
Okay.
This is the acronym used by the federal government. It's called the Home Equity Conversion Mortgage.
Okay.
That basically allows you to convert a portion of your equity into actual cash you can use for any reason. And then over the last 10 years or so, we have what is called the private label proprietary reverse mortgages.
Okay.
Traditionally, they'd be called jumbos. That was for homes higher than $1 to $1.2 million, because the lending limit now for HECM is $1,089,300 in the U.S.
Okay.
So there was a void there for higher price homes in higher priced areas. So again, because we don't have the federal government involved in everything, private label, private investors actually came into the marketplace to fill that void and provide a financial instrument that will be beneficial to homeowners that have higher price values. Right now, we can issue a reverse mortgage. They still have the same guidelines, but we don't have to provide them with a mortgage insurance. And we can actually issue a reverse mortgage to a home valued at $10 million.
Wow.
Whether it's a single-family home or a condo. So for higher-priced areas like Denver, for instance, it's a prime example to be able to utilize that tool for someone over 55 because the proprietary reverse mortgage has a lower age limit. So the age limit is 55 in Colorado.
Okay.
For the traditional HECM or the FHA insured reverse mortgage, the age limit is 62. So one of the homeowners have to be 62. The other one can be as young as 18, believe it or not, because this is the legal marrying age in the U.S.
Okay.
So
Wow.
we do the calculations on the age of the younger of the two borrowers.
Okay.
Qualification is very easy. They have to use it as their primary residence.
Okay.
It can be a second home. It cannot be a vacation home. And we define primary as the residence that somebody uses 6 months plus 1 day per year.
Okay. Got it.
They have to be able to at least pass what is called minimum financial assessment requirements. We have to use the residual income that they have every month, the net income basically after they pay for all expenses, and to make sure they have the ability and the willingness to enter into this financial transaction, because that's what it is at the end. It is a financial transaction. And then they have to be able to pay taxes and insurance and maintain the property. That's it.
Okay.
They can stay there for the rest of their lives, payment free. And we can go through some of the specifics, the different uses of a reverse mortgage, and I give you some examples as well.
Yeah, I'd like to hear some examples and some uses and maybe what you're seeing is most relevant in this market right now. A question about, just the process of getting approved for a reverse mortgage. Is that just the same as going through and getting like pre-approved for a traditional mortgage as well? Like they just would talk to you and you would get the documentation that you need and run everything by underwriting and then let them know? And is there any cost to that?
No.
Okay.
Everything is free that we do up front. There's no cost charged to the client. Very similar process to what we do on the forward side of loans.
Mm-hmm.
However, it's a lot easier to qualify for the reverse mortgage for a few reasons. Number one, we don't look at the FICO score. FICO score is secondary.
Don't look at the credit score.
No.
Okay. I didn't know that. See?
So we don't need to have a minimum FICO score to qualify.
Okay.
As for the traditional FHA loans or for the traditional conventional loans.
Yeah.
However, we look at the overall financial picture of the individual. We look how they use credit, number one, and their ability to maintain their financial obligations. If they're able to pay their credit card payments on time. If they have installment loans, they're paid on time. And then they have to have residual income based on the area of the country they live in. In Colorado, for instance, we have for a family of one, we need $589 a month.
Okay.
To qualify. That's basically it. And you can qualify for up to $1 million house. We can get up to $589
$589 a month.
Correct. Residual
income.
This is the net income, right?
Right.
After all expenses.
After the expenses are paid.
It's not unusual for somebody, let's say, with $2,000 Social Security check, fixed income. That's it. They don't have any other assets. They don't have any other income coming in. They will be able to qualify. If they live in $1 million home, we can get a $400,000 reverse mortgage based on that. If they have more than $589 a month in residual income, for a couple or a family of two, that raised up to less than $100,000, just $998. That's basically it. If they fit those requirements, then they qualify for the reverse mortgage. And in cases that, let's say, someone has had some major medical expenses, life happened to them, was death in the family, long illness that required extensive care, additional expenses, and the credit report wasn't very good, or they had to file for bankruptcy, whatever the case may be, then we can set up an escrow account similar to what we have on the forward side. It's called LISA, Life Expectancy Set Aside. So we put aside the taxes, the property taxes that need to be paid, and the insurance until they reach the age of 87.
Okay.
So that alleviates that additional financial stress if they don't have the money to make those payments.
So it basically sets aside the property taxes and the homeowners insurance until they turn 87 years old.
Correct.
Okay.
So that's a great financial tool to be used for homeowners that want to age in place. Let's say somebody has a $1,500 Social Security fixed income a month, and they live on $1 million house, and they have $5,000 a year in taxes and insurance, which is not uncommon right now in Colorado.
Yeah, especially with the jump recently.
Correct.
Yeah, it could be even higher.
It could be higher, yeah. So let's say they're in the mid-70s. Let's say they're 76. We can set up, if there's enough equity in the house, we can set up 10 years times 5, right? That's $50,000 plus increases every year, 2.5 to 2.8%, because taxes will go up in traditional markets. And at the same time, homeowners insurance most likely will go higher as well. So we set aside $50,000 to $60,000 to accommodate that homeowner to age in place for the next 10 years. After 87, which is the life expectancy, then at some point they will be on their own to determine if they want to stay in that house or go to a different location, make some different arrangements, and move on.
All right. Great information. Let's talk about some, benefits and potential uses. So maybe some real life examples of what you're seeing right now.
This is what happened during the pandemic. Everybody knows what happened over the last 2 years. We have witnessed, all of us, these very uncomfortable scenes in nursing homes in different states, specifically New York. People being behind glass, not be able to touch their own family. And in many cases, when COVID was in its height, I guess, there was a lot of deaths in those facilities. And what that did is it changed the mindset of how to deal with our family members. They're getting older in age, trying to figure out different ways to accommodate their needs as they age, instead of going into a nursing facility or a nursing home, if you will, that doesn't provide the same freedom and connection they're used to having with their own families. So that mindset completely shifted over the last couple of years. So what we see now is that even kids in their 40s and 50s thinking about their parents, their grandparents, how to insulate them as they're getting older in years. One of those situations is, how can we find a way to make them age in place and be happy doing that? So what we use a reverse mortgage in many, many cases right now is to make their house more livable. If we need to make arrangements to accommodate a physical impairment, if you will, or difficulty, we can eliminate steps, stairs, ramps. We can install handicap bathrooms with the money we can get out of the equity of the reverse mortgage. We can lower the cabinets in the kitchen. And at the same time, give the individuals the opportunity to do what? Be happy aging in place.
And staying
in their own home. Being in their own connected environment with their friends, their neighbors, their family members will be able to visit, right? So we've done a lot of those things over the last 2.5 years. Second one is we have a shift right now that families want to be closer together, geographically closer together. If we have family members, kids, and grandkids in a different state, we have seen a lot of migration either to that state from Colorado or from other states to our state as well. I've even done a couple of transactions, people that move, let's say, from Thornton and Westminster to Parker, simply because the grandparents didn't want to make the trip on a weekly basis, which in many cases is not that easy anymore, driving up and down I-25.
Right.
So selling a property in Westminster, buying another property with a reverse, so we can go over that option as well, in Parker, gives them the opportunity to be closer to friends and family.
I like that. So the purchase side of the reverse mortgage, right? Because I think that was one of the misconceptions every time that I've talked to people about it is like, I want to keep my house. I don't want to sell it to the bank. I don't want to be stuck here too, and then this whole purchase side of reverse mortgage is I think news to a lot of people. So maybe talk about that. Like,
sure.
How can you do a reverse mortgage on a purchase?
This is kind of a simple process. Actually, the thinking changed with the mortgagee letter back in 2009 that expanded, the reverse mortgage that existed at that point to include, new purchases. Why is that? They found out that about 33% of our seniors, after between ages 65 and 74, this is the go-to years we call it, they decide that their home is no longer fit their needs. Number one, too big,
Stairs.
2-story, stairs, large yard, maintaining. So being an empty nester, it doesn't completely fit their needs. So they wanted to either, I call it right size. Some people call it either downsize or upsize. It doesn't matter. It's not right. That home is no longer right for the individual.
Right.
So they wanted to sell it and get something that would be more suitable for their new needs, right?
Right.
The new desires. They wanted to travel. They wanted to get their dream vacation, volunteer. Everything that they needed to do with their lives, they haven't been able to do before, simply because they were working and raising a family. Mm-hmm. So between 64, 65, and 74, that decade, I call it the go-to year. So they want to do all the things they haven't been able to do before.
Right.
So in 2009, FHA and HUD realized that that was a need that didn't exist before. Again, they wanted to come in and fill a void because we found out that our seniors were going in and buying new houses. Mm-hmm. The traditional way to buy the house is cash. Mm-hmm. You sell a home for X, you sell a house for $700,000. They want to buy another house for $700,000. It's a simple transaction. It's a cash transaction because it doesn't make sense to enter into a 15 or 30-year mortgage in your 60s and 70s. So most of the transactions that we've seen was for cash.
Right.
Now with the reverse, gives them an additional option. Think about it this way. A year and a half ago, for instance, where the rates were a lot more reasonable than they are today, somebody wanted to buy an $800,000 house, they can do that by putting $400,000 down and getting a $400,000 reverse mortgage without having to make an additional payment.
So they keep the extra $400,000
correct
that they would have had to put down if they bought in cash.
Correct.
Now they keep that $400,000 and they still don't have a payment.
Correct. Ever. As long as they live in the house and they meet the minimum loan requirements, which is to pay your property taxes, pay your insurance, HOA fees, if they do exist, and maintain the property. That's it. But imagine now having the liquidity.
Right. Yeah.
Of an additional $400,000. Right. And let's just say that individual is the only additional cash they have. They don't have any 401ks, IRAs, or any other investment accounts. And some people tell me, well, this only involves the most affluent client. And I disagree with that because it gives an opportunity. It's a viable financial tool to be used correctly for the right reasons, even for the more wealthier clients. Let me give you an example. I had a couple that wanted to sell a $2 million home in Cherry Hills, and they wanted to buy a $2 million townhome in Cherry Creek. My question was, why?
Right.
You're moving 3.5 miles away, right? Mm-hmm. The wife says, walkability. You can't walk anywhere in Cherry Hills. I love my house. I love my neighbors, but everywhere I have to go, I have to get in my car and drive. Mm-hmm. I can't walk anywhere else. Go for coffee, I have to drive. For lunch, I have to drive. Shopping, I have to drive. If we move to Cherry Creek, I can walk everywhere. Mm-hmm. All my friends meet in Cherry Creek for lunch. Wonderful, right? Easy transaction. But the husband wanted, now that they're retired, both in the early 70s, said, I want to buy a second home for $1 million in Scottsdale. Let's go to Scottsdale 2-3 months out of the year, play golf when the winter is really bad here in Colorado. They don't ski anymore. So the first thing he does, calls his financial advisor, and he says, this is what I'm doing. I'm selling my house in Cherry Hills, buying a $2 million home in Cherry Creek, liquidate another $1 million on my investments. I don't want to have a payment. I want to pay cash for my house in Scottsdale. Fortunately, this financial advisor is one that I talked to in the past. We had interactions. We did some other transactions together in the reverse space. And he says, well, have you thought about using a reverse mortgage to buy one property, the primary here in Cherry Creek? He says, no, reverse mortgages are for people that don't have any money. We do have some money, so I don't want to use a reverse mortgage. The real estate agent, of course, in the transaction, heard about the reverse mortgages. He was not happy either because, my goodness, I'm not going to make an offer in Cherry Creek with a reverse mortgage, right? At the end of the story, all of us met together. I put a proposal together, how that made sense for the client. Presented the proposal to the real estate agent, the clients, and the financial advisor, and it was pretty simple. We used $1 million as a down payment from the sale of the home in Cherry Hills. To purchase the house in Cherry Creek, we got $1 million reverse mortgage.
Okay. Yeah. So they keep
the
that
remaining $1
million
million they had in cash, they pay cash for the property in Scottsdale. Here are the benefits. Number one, they saved themselves a little bit over $200,000 in capital gains because they didn't have to create a taxable event by liquidating $1 million in their investments, right? It gave them an opportunity to purchase $3 million worth of properties, $2 million in Cherry Creek, $1 million in Scottsdale, with only $2 million in cash. And at the end of the day, the client had only one question for the financial advisor. He said, can you make me more of a return in that $1 million that I'm paying in interest right now? He says, we already have doubled that over the last 5 years. Done. In 30 days later, we closed for the house in Cherry Creek.
Fantastic example. That's a great story. What are the cons then? Like that client, if he's saying, it sounds like pro. Like what's the negative aspect of it?
I want everybody to think about it this way. It's a long-term solution. If a client says this is a short-term solution for me, I want to get money for the next year or two.
Right.
It doesn't make sense because the upfront costs are higher than the traditional mortgage. Okay. So let's say we have $1 million house. The largest expense right now in terms of cost is mortgage insurance. Mm-hmm. It's insured by FHA. The mortgage insurance is 2% of the appraised value. So we have $1 million home. That's $20,000 that will be added to the loan. Okay. They don't have to pay it up front. It just added to the loan, to the balance of the loan. $20,000, that's a lot of money. Yeah. So if somebody says, I'm thinking about moving next year, selling my house and moving to Florida, let's find another financial instrument that will create the path that you want to go to without that additional expense. Because once you pay the mortgage insurance and you sell the house a year from now, 5 months from now, you don't get that money back.
Okay. So that's where the bank benefits.
It's not the bank. That money goes to the insurance fund that's managed by Congress.
Okay.
Keep in mind that this is insured by the federal government. Okay. It's a non-recourse loan. What does that mean? That means that no matter what happens to the property values, the homeowner, the heirs, or anybody else involved with the property, they will never owe more or have additional financial obligations than the actual value of that collateral. Let's just say we have a $500,000 loan that grows to $1 million over 25, 30 years. And the property, at that point, we have another financial crisis. It drops down 50% in 12 months.
Okay.
The property value now is $500,000. We have $1 million loan.
Yeah.
The heirs of that property, they have a choice. Traditionally, they sell the property, pay off the reverse mortgage like any other mortgage, and whatever equity we have left, that goes back to the trust or it goes back to the heirs.
Right.
In this case, we have $1 million loan, $500,000 appraised value on the property. So we're $500,000 upside down.
Mm-hmm.
Because this is a non-recourse loan, it protects the homeowners and the heirs for any future financial obligations. So you call the lender, you give them the keys, and you walk away. The mortgage insurance kicks in, pays the lender full that $1 million. So the lender has zero risk.
Okay.
So there's no incentive. A lot of people tell me the bank wants to actually get the house, and the only way to do that is with a reverse mortgage. That's not true. It's absolutely false. What's the incentive from the lender to do that if he knows for a fact, no matter what happens to the value of that collateral, he will get reimbursed 100% with zero risk?
And has that changed then? Like prior to 2009, would the bank own the house no matter what if a client did a reverse mortgage?
Here's the misconception about the reverse mortgages. When people talk about there's no payment required, they think about all kinds of payments tied to that home. For instance, property taxes.
Right.
Property taxes are mandatory to be paid, whether you have a mortgage on the property or not. Homeowners insurance, also mandatory. If you don't pay that, then something bad will happen. If you don't pay your property taxes for 2 years, what's the next step?
The county would try and take the house, right?
Exactly.
Because,
Exactly. So,
liens against the property.
Right. So the obligations that we have, because we are homeowners, are there regardless if we have a mortgage or not. The way that we make those payments on the forward side of mortgages, we set up an escrow account that we collect a portion of that payment every month to pay taxes, to pay your insurance for the whole year.
And is that new?
No, it's always been there.
So it's always been.
It's always been there.
Okay.
But the bad thing about it is, think about it this way. If a property needs to be foreclosed because of non-payment of property taxes, and somebody finds out that during the process there was a reverse mortgage attached to the property, everybody says, my goodness, the bank is foreclosing on the property because of the reverse mortgage to steal the property from the homeowner. That can be nothing further from the truth. It's completely false.
Did it used to be the truth, though?
Well,
like back in before 2009?
No.
Okay.
But a lot of people think about the silent generation and the baby boomer generation to some extent. We have a generation that grew up in the 20s, 30s, and 40s. Traditionally, the husband made the financial decisions and paid the bills.
Right.
So if the wife knew that we got a reverse mortgage that doesn't require a monthly payment in the traditional sense, in many cases when the husband passed, the spouse did not know that he was making the monthly payments or yearly payments to the homeowner's insurance and pay the taxes once or twice. She thought no payments, there's no payments required of any sort. So the disconnect happens when that becomes a reality and we don't have enough education in the system to let us know that, and I tell all my clients over and over again, if they are used to a traditional mortgage, it's a new set of reality right? That we need to pay. You have to think that if your property tax bill comes in, you have to make either 1 or 2 payments in Colorado. Or your insurance, homeowner's insurance is due, you have to make arrangements to pay it yourself. The lender, in the traditional sense, cannot make that payment unless there's a need from the homeowner, as we discussed earlier, because of financial hardships and not enough income to do so.
Gotcha. Okay.
Does that answer the question?
Yeah,
does that make
it does.
A little bit more sense?
It does. I mean, it sounds like the education hasn't always been there from the lending side, but it sounds like that's coming around now. And it sounds like you put an emphasis on making sure that if you're getting someone into a reverse mortgage, they know the pros and the cons.
Absolutely.
And the risks.
Absolutely. And another thing that happens right now is we have mandatory counseling, they call it.
Okay.
So that's a third-party agency that is approved and licensed by HUD to provide exactly the information that you and I are discussing right now to the homeowner.
Is that required? For them to do?
Required. Absolutely required on every HECM and proprietary loan. It doesn't matter if it's a jumbo or not. It's required prior to ordering any services. in many cases, and in some states, you cannot even sign an application without that certificate has been issued.
Gotcha.
First.
That's good.
So that's a safeguard there put in place to make sure that everybody's aware that this is still a financial obligation that this individual has, right, moving forward. It's not free money. It's still a loan. The way that it's paid back is the difference between a traditional loan and a reverse loan. The reverse is deferred payment, like a balloon payment, if you will, at the end of life when you sell the house or you move away for longer than 12 months.
Okay. But if you've got equity in the house, then you're fine. You've got options, right?
Absolutely.
Like the heirs have the option to sell
Absolutely.
and take that equity.
Absolutely.
It's not the banks.
Absolutely.
And I think that's what I always thought was that, just the bank owned it regardless. But from what you're saying is it is similar to a traditional mortgage, but the difference is that, like you said, it's deferred payments.
Correct.
And the costs are just added on to that loan amount, right?
Exactly.
So instead of you just paying that every month, it's like,
Exactly.
hey, we're just adding this lump sum onto the loan balance. But in most situations, if you're getting into a reverse mortgage, whether it's on the house that you own, well, I guess in every situation, whether it's on the house that you own or the house that you're purchasing, you have to have a certain amount of equity heading into that, right?
Absolutely.
Does that loan to value percentage, in other words, does that equity amount fluctuate depending on the situation, or is there like a set amount?
That's a great question.
Fluctuates?
It does.
Okay.
We have 3 actual metrics that we use altogether. One of them is the age of the younger borrower.
Okay.
The older someone is, the more money available to them in a reverse mortgage. Second is the value of the property.
Mm-hmm.
It's a percentage of $1 million. If it's 50%, it will be the same 50% of a $500,000 property or a $200,000 property. The third one, which is very relevant to what's happening in our industry today, are interest rates.
Right.
The reverse mortgage has the ability to calculate how much somebody qualifies for. Is tied to the 10-year treasury.
Okay.
So the higher the 10-year treasury is, the less money available to the homeowner.
Okay.
If we flip that on the purchase side, the higher the 10-year treasury is, in very simple terms, the larger the down payment requirement.
Okay.
So those two go together.
Okay.
So what's happening right now is 14 months ago, we had 10-year treasury about less than 1%. Now we're approaching 5%.
Mm-hmm.
So 14 months ago, somewhat 62, they needed to have about 50% equity in their home to enter into a reverse mortgage. I want to make sure that everybody understands. If there's not a net benefit to the client, we will never recommend a reverse mortgage.
Mm-hmm.
It has to be a net benefit to the client.
Right.
Right now, the rates being in the 7s, approaching 8%, and the 10-year treasury close to 5%.
Mm-hmm.
Prime is about 8.5%, which doesn't make the situation a little better. The LTV, the loan to value, if you will, has decreased from 50% down to between 30 and 35%.
Okay.
So someone has to have at least 65% equity position in the house to qualify for that, or have about 65 to 70% down payment to purchase another house with a reverse mortgage. Still, the benefit is that imagine buying a house at 30% discount.
Yep.
Imagine buying a house $1 million, right? But instead of putting $1 million cash, you put $700,000 down payment and get a $300,000 reverse mortgage.
Got it.
There's still a benefit there. And another thing I want to mention real quick is, in this environment, the best use of a reverse mortgage is for people that don't actually need one. What do I mean by that?
Yeah, what do you mean?
Let's just say somebody has $1 million home free and clear.
Right.
We talk to them. It doesn't make any sense. I don't need the money. I have investments. I have this. I have the other. That's great. So they have $1 million in equity that's not liquid. Mm-hmm. What we can do, let's tap and start a reverse line of credit.
Okay.
Similar to a HELOC, if you will. You don't need to get it now. You don't have to let it sit there. Let's just say we can start a line of credit at $400,000.
Mm-hmm.
The unique feature of a line of credit within a reverse mortgage is that it has a growth factor attached to it. What does that mean? that money, that $400,000, right now it will grow about 8.5% a year, tax-free.
How does that work?
Well, if the money is not used, every year that goes by, the individual is a year older. So he's entitled to get slightly more money back.
Oh, okay.
Again, it's attached to the 10-year treasury, the index that we use, which is the CMT, constant maturity treasury that we use, plus the margin that we have, plus 0.5% of mortgage insurance that's added every month. Right now, it's about 8.5%. That's the growth factor. So $400,000 line of credit will grow, let's say, about what, $35,000 a year.
Right.
So you have $435,000. It will continue to grow. This is the key factor, independent of what's happening with the value of the property. It doesn't matter if the property values go up or go down.
Now, is there the option to not access those funds then?
Absolutely.
Okay.
Absolutely.
So it's just available in case you need it.
For any reason.
And in the case that you need it,
correct,
you can use it. But
correct,
in the case that you don't need it, you don't need to use it, and then those fees don't apply.
Correct. Let me give you an example about that. What we've seen changing over the last 2 years with COVID again is a lot more people wanted to be able to participate, if you will, in whatever money they gifted, whether it's family, the church, another charitable organization, or a cause that they felt very passionate about. We have some clients that said, I want to donate $200,000 to build an orphanage in Ghana. And I'm going to be able to enjoy that process. How many lives it actually changes. Can I take money out of my equity now? I'm going to leave the house to my charity of choice or to my church. When I pass, they can sell it and then they can take the funds and do whatever they need to do. But what if I were able to get that money to them sooner and be able to join them in that effort to build that orphanage, to build that school in Ghana? And we've done that. Another thing is someone said, I want to donate, I want to help my kids because I have 2 sons, they have kids in college, my grandkids, I have $1 million house free and clear. They're going to get the house when I pass, right? What if I'm able to give them some of that equity now, pass it on to them, join together to find out what they're going to do with that money, whether it's to pay for college, to get a new car, get a dream vacation. Dream family vacations are huge right now. Generational vacation, they call it. Take the kids and the grandkids together.
Yeah.
So we're able to do that as well. It doesn't need to be specified what to do with that money.
Okay. So in gifting funds to family through the reverse HELOC, and I'm sorry, what is exactly is that called?
The reverse line of credit.
The reverse line of credit. So they don't take a tax hit then like they would.
It's not taxable income.
It's not
taxable
still a loan.
Income.
Okay.
It's a loan against somebody's property.
Gotcha.
It's not a taxable income.
Okay. And so the benefit of that type of loan, the reverse line of credit, compared to just a regular HELOC, is that the reverse line of credit is going to grow as they get older. Yeah.
It grows every year, regardless of what happens to the property value.
Okay.
Number 2 is it doesn't require a monthly payment. A HELOC does. If you access that money, you have to pay it back.
Okay.
Whether you pay it back on a monthly basis, you pay the interest alone, fixed, whatever the case is, it requires a monthly repayment. This one does not. But if you don't use that $400,000 HELOC, let's say for the next 10 years, just going to use it just as an example, that $400,000 will become $800,000.
Okay.
This is $800,000 that will be available to the homeowner within 48 hours for any reason.
Interesting.
All of it at once or a portion of it.
Okay.
In addition to that, if we have to that point, they can use the money for, let's say, for medical expenses. They can use the money for home care. They can use the money for monthly income. We can schedule a payment to the homeowner, either for a term of years that they want to do, and I will explain that a little further, or for life. They can draw $1,000, $1,500, $2,000 a month from their equity to supplement their income for the rest of their lives.
So they're basically taking a loan out from their equity without needing a payment.
Correct.
Okay. Is that common?
It is.
Yeah. Okay.
Let me give you an example. Let's say we have a couple, both of them are, let's say, 65. They're going to take an early retirement, but they want to continue not apply for Social Security benefits until they reach the maximum age, which is 70.
Okay.
But they have a
Makes
5-year
sense.
gap.
Right.
I want to retire today at 65, but I need my $3,000 a month Social Security to be able to do that.
Right.
Well, here's an option. We can structure a payment for the 5-year term, if there's enough equity of somebody's home, to take out that $3,000 payment, allow this individual to retire now, and then 5 years from now, when he turns 70, then we stop.
You turn it off. So you can
turn it
on and off.
Absolutely. We can turn it on and off every single month, every 30 days, basically.
Now, will what if home values fluctuate? Like, does it continue to get reappraised, or
No.
okay? So it's just the appraisal that's done at the time
At application.
At application.
Correct.
That's what it is. Okay.
Here's the benefit, though. Every 12 months, FHA says that we can actually review a reverse mortgage and find out if a refinancing of that reverse mortgage will be beneficial to the client. And we have to comply with a specific test supplied to us, all lenders basically, by FHA. The minimum requirements for that is we have to have a net benefit to the client in terms of closing costs, 5 times the closing costs. So we can do a refi to generate commissions, basically. It has to be a net benefit for the client.
Right.
If there's a lower rate, higher valuation that we had in Colorado for the last 3-4 years, it was a perfect example, and I've done several refinances over the last 3-4 years in Colorado simply because it was the perfect environment for the client to benefit from that. Right. Lower rates, increased values, they can access more funds out of the equity. So we can monetize that equity a little bit more. Okay. And another thing that it's been really, really front and center over the last 2 years, everybody that's followed the stock market, last year, both stocks and bonds for the first time in a very long time, decades, both of them were down on the same calendar year. If you just in stocks, we're probably down between 20 to 24%. Bonds on the other side, very conservative portfolio, was down between 14 and 17%. So let's assume an individual homeowner that retired wanted to take withdrawals out of their investment account, your IRA, 401k. If your account is down 20%, even if you start from $1 million or $500,000 in investments and you have made the calculations to last you that long for the rest of your life, your account now is worth 20% less. Does it make sense to liquidate funds when the market is down? That's called the sequence of return risks. So what we do with financial advisors and planners and real estate agents as well, to find out if we have a down market, more than 2%, don't touch your investment account. Allow it to recover. It almost always does. And at the same time, if you need the $30,000, $40,000, whatever you need to maintain your lifestyle now, let's take that out of your equity. If we do that 4 times over the next 30 years, you'll be able to see a dramatic difference. And we have a calculation that we do that to show what happens to that investment account, your portfolio, and the equity that you can leave to the heirs.
Well, it sounds like talking to a reverse mortgage specialist like you is just good practice anytime you are thinking of liquidating funds from an investment account.
Absolutely.
Right? Like, at least just have the conversation.
My advice is always free. I don't charge for anything. My time, I'm available for everybody that wants to give me the opportunity to explain to them how or why, to give them the benefits and the costs of using that equity as an actual asset.
As an asset, and just to help their financial planner understand that situation as well. Do financial planners, are they pretty savvy about reverse mortgages?
They're not.
Okay.
They're not. Traditionally, because this is not a financial instrument that they can actually offer themselves, they tend to shy away.
Yeah.
In many cases, there's been in the past compliance issues.
Yeah.
Simply because they didn't consider that asset to be a liquid asset.
Mm-hmm.
Now, over the last 5 to 6 years, we have seen that mentality is shifting.
Yeah.
What I mean by that is all of a sudden now we have that asset class by itself, which is the primary residence, right?
Mm-hmm.
And now we can use that, if we can monetize that class, that asset, into the retirement income planning.
Mm.
So what they do is they take the asset that until now it wasn't actually in the calculations that they did. And now they say, okay, we can actually put liquidity into that asset and how that liquidity can change my client's longevity, because everybody wants to make sure they don't run out of money. That's the number one thing.
Right.
I want to be able to live my life to the fullest without running out of money.
Yeah.
That's the number one thing. And number two is cash flow. How can I maintain my lifestyle now, moving forward for the next 25, 30 years, 35 years, without having to make a lot of cuts? Yeah. And we find out, even last year in Colorado, all the additional increases that we had, energy increases, inflation, cost of living, property values, insurance, gas. Groceries, so for somebody that is used to living their life on a fixed income, because most of our retired people live on a fixed income, it's very hard to be able to maintain that standard of living that you were used to until a couple of years ago.
Yeah.
So now we will say, okay, if you're not able to make your monthly payments, and someone here is in a position now to decide, do I pay my homeowners insurance or put food on the table? It doesn't make sense to have equity there that can be liquid to help you move through those challenges, financial challenges right now, that we can actually live there.
Yeah. I think that's a good option that people should consider. And at least, like I mentioned before, at least have a conversation to understand what the options are. And just another reason, with understanding these reverse mortgage benefits, just another reason to get into home ownership in general too, because if you're a lifelong renter and you get to that point of, retirement and wanting to maintain a lifestyle and still, keep up with all of your bills. I mean, it's nice to know that you can access some of that equity, defer the payments, and, increase your cash flow that way. How do you use a reverse mortgage to buy your dream home?
What a great question. Actually, I have a CE course that I teach here in Colorado, approved by DORA for financial advisors and also, real estate agents and realtors, to show them how to enter into this new market with a baby boomer buyer. 10,000 people retire every single day. 10,000. And that will continue to happen for the next 15, 20 years. We're aging faster. We're living longer. So the needs of that aging generation is going to change over the next 15, 20 years. It's a very underserved market. As we said earlier, about 25 to 30% of those baby boomers will actually become the new buyers. And right now, that generation is the second largest buyer, next to the millennials, of course, in the market today. And because they have the largest amount of equity or housing wealth, I call it, almost $12 trillion, they have the ability to buy that dream home without making too many other concessions. In the traditional sense, it was a cash transaction. As we said earlier, it doesn't make sense to get a 30-year loan at 70 or 75. So it was a lateral move. If it was to upsize and buy your dream home, buy your home next to the golf course, seaside, whatever the case may be, and allow you the opportunity to do that now by not using all the cash from the sale of the departing residence, save some of that money, use a reverse mortgage, buy your next dream home, and you don't have to make a single payment back as long as you live in the property, pay your property taxes, insurance, and maintain the property as well.
And the taxes and the insurance can be set aside in an
Correct.
escrow account anyway.
Correct.
You mentioned the CE course that you do. So how often? I'd like to do one of those with you too.
I'll be happy to do it.
Okay.
Very simple.
Yeah.
We set up a date that's available to either me and you or both of us together. Yeah. We create a flyer for that event with a registration link. It's usually done in our branches here in Colorado. We can do it at Greenwood Village or in any other location. We can even go, I do VIP courses for specific teams, if you will, within a brokerage. Okay. They say, I have 5 members in my team. Can you come and do a class for me? I'll be happy to do it. It's approved by Dora. It's a great event. People love it. Realtors love it because it opens up their minds, how to create new listings in this very challenging market, which is reason number 1 to get it done. Yeah. You need to find out where the baby boomers live. You need to find out how you can market to those baby boomers, how to help them buy their dream home, how to help them say, I have a solution, I have a path for you, how to sell that 2-story, 3,500 square foot house that you have now, and we can buy your ideal dream home, patio home, on the 18th hole at the Glenmore or some other golf course, right? This is what you need to do. Find a path how to get it done. At the same time, it gives you the ability to buy at a significant discount, even if right now it's only 30 to 35%.
Well, it seems like it's such a, well, you mentioned the baby boomer market, you said it's the second largest, or the baby boomer, what would that be, age range?
Yeah.
They're the second largest buyers in this market right now. I feel like that's unknown.
It is unknown.
And it's hard to, I guess it's hard to access. So I think if realtors are equipped with the benefits, they can help sell that.
Correct.
To that market.
What's happening in major cities right now, we have a very tight inventory.
Right.
Especially here in Colorado and, Denver Metro. Yeah. Part of the issue, I think, this is my personal opinion, of course, is that baby boomers have not been able to make a decision to move. Basically, they've been paralyzed. Part of that was the year and a half due to COVID, right? Nobody wanted to move. And when everybody came back to normal life, now they see the interest rate environment, the price wars that we had last summer, my goodness, paying $50,000, $60,000, $70,000, $80,000 over asking price, appraisal waivers as well, which is unprecedented in Colorado. So now they're saying, if they do have a small mortgage left, I have a house here that I'm paying 3%. If I want to get another house that I still need to get a mortgage, I'm looking at an 7.5% range. And I said, that's not good enough for me right now. So they stay put. Yeah. The interest rate makes a difference on the reverse side, but not so much because it doesn't require a monthly payment. Right. So it's a secondary issue, if you will.
Now, we could talk on this for so long.
I can talk all day.
That's great information. Where could our listeners find you? I'll put a link to your website as well. Would that be the best place?
Yes.
Yeah. To reach
best
out
place.
To you on your website.
Reach out on my website. You can email me. You can text me. My number is there as well. Yeah. I'm always available. I answer my calls, and I will always answer my email or any text that somebody sends me. Any information, I'll be happy to assist. Yeah. And in many cases, people call me and ask me questions. I have my family member, my dad, my mom, my grandparents. They're thinking about doing this. What do you think? Yeah. I will give them my honest opinion, and then they can make their own decision.
Well, George, I think this is all great information. Anything else you want to add here before we finish up?
I just want to say one thing. Think of the reverse mortgage as a lifestyle loan. For anybody over 55, it's a viable financial tool that can be a life-changing event moving forward.
And on that, I want to thank you for listening. Like us, subscribe, comment, communicate with us, give us a review on Apple Podcasts. We really appreciate all of you, and we'll see you next time.